Hey there, everyone. My name is Ryan. Welcome to my channel. So, in the narrative today, I want to talk about Monte Carlo risk simulation and what is it and how do we use this in a practical fashion, right? So, Monte Carlo risk simulators basically turn unknowns into actual probability distributions so we can make intelligent decisions, right? With more information, we can make more informed decisions. If you're just guessing from your gut, um, you can't really make like an informed decision, right? It's just like that's your feeling on that particular day at that point in time. That's not really like a real mathematical, quantitative decision, right? But with Monte Carlo simulators, we can use the outcomes to determine, estimates, probabilities, uncertainty, reality, things like that, right? It can help us with P&L, which is profit and loss, costs, timelines, potential outcomes, right? For anything from supply chain management to manufacturing to aviation, automotive manufacturing, government, education, nonprofit, for profit, finance, Wall Street. There's so many applications for this, guys. There's so many ways to use this, right? So we can measure what's the chance of something happening, right? What's the probability of an outcome, right? What's the break even point? What's breaching or loss limit? Measure tail risk, right? That's the if you have a normal distribution bell curve kind of simulation outcome. What's the risk of a certain outcome above the threshold that you would normally expect? Is it 2%? Is it 1%? Is it 5%? Right? To know this information and to make actual decisions on that is very important, right? That can translate to millions of dollars, maybe tens of millions of dollars to your bottom line if it's done correctly, right? I've done this before, so I know how this works. Capture correlations, right? Stress, multi-factor shocks, compare strategies, pick policies. What's the best possible outcome? How can we adjust the risks and manage the risk of our business? How can we understand the metrics? Um, the potential downside or negative outcome and potential upside. Maybe we have a positive outcome too. How can we quantify this? How can we manage that, right? Prioritize drivers of the business, be able, again, to make intelligent, informed decisions, um, understand buffers. There might be a potential loss or a setback or something like that. What's the probability of that? Is it 1%, 2%? Is it 5% chance of loss? Is it 1/10 of 1%, right? Like these are things that we can quantify and try to understand and try to manage better, right? In terms of governance and compliance, Monte Carlo simulation can help with that. Any kind of value or flexibility, we can understand that, and then learn and iterate, and then back test these different scenarios and calibrate to the history based on historical actual information, right? It's going to be different for different businesses, but based on your historical information for your business going forward, how can you use that to determine what most likely is going to happen next, right? That's how we can manage our business, right? So understanding finance, of course, its applications in that, supply chain operations, energy, project management, pricing, revenue, economics, things like that, right? Can help in so many different areas. So I put together the script. This is going to be pretty short and pretty sweet. Let me run this, Control Enter to refresh my cell. I have a bunch of stock tickers listed over here. This is basically like the Dow 30 components. These are all the 30 in the Dow. I'm starting on 2020, January 1st, and trying to understand basically what is the probability of this portfolio generating income and some kind of profit, some kind of economic profit, or like alpha. It's called positive alpha. Am I going to get an alpha on my portfolio? Am I going to make money, or am I going to lose money, or just break even, right? If I break even, what's the point? There's no point. I don't want to do all this work and lose money. That doesn't make a whole lot of sense, right? But how can I use this portfolio to understand quantitatively and holistically and economically, how can I generate a profit from this? So we're going to look at the closing price. Right here, I have several videos on my channel that discusses how this works. Right, you pick the stocks that you want to look at. You pick the start date. You go backwards in time for a period of time, and we're looking at the closing price. Right, so we're going to generate these holistic prices and look at a couple different metrics over here. These are different risk metrics, right? To understand, what's the distribution of this risk? What's the likelihood of this certain outcome? And can we understand the sigma or the standard deviation or the variance of this probabilistic outcome to either occur? Are we going to achieve the desired goal or overachieve? Maybe we can generate a higher positive alpha, or maybe underachieve, right? And what are the probabilities of all of these outcomes, right? So I'm going to share all this code with you. I'm going to give that to you. This is going to be a short and sweet video, pretty transparent, pretty upfront. You can copy and paste this code and run it in your own Jupyter notebook and get the same results that I'm going to get. These are different statistical metrics and different averages and different potential outcomes, right, for this portfolio of stocks. So you're going to what's it called? Like overachieve or whatever, achieve a higher return on the portfolio, or the actual return that you expect, or are you going to underperform on the portfolio too, right? So that's what this is for. We're looking at this this time frame right here, right? And these are the stocks I'm picking. So here's the metrics right here. This is the variance, 95% confidence. So here's the payoff here. We have the expected 95% payoff right here. This is pretty standard. You have the top 95%, you have the bottom 95%. Over 95%, that's highly unlikely, but you could achieve that. But you're probably not going to achieve like a super normal return on your portfolio. Just statistically speaking, it's probably not going to happen. It's probably going to be in the mean. This is the average, and this is the most likely outcome. If you do achieve higher, you have a 2% chance of achieving the higher, right? And you could achieve lower too. You could have like about 2% chance of underperforming, way under what you would expect too, and it could happen. Honest to God, guys, there are hedge funds that go bankrupt almost every single day, maybe every single day if you do the math, maybe every day, because they don't understand the real risk that they're dealing with. They don't understand the underlying risk that they themselves are underwriting. They're underwriting this risk by buying these stocks, right? If they don't understand that, you could be bankrupt very quickly, right? In a few days. You saw this happen many times in the past with Melvin Capital, Long-Term Capital Management. There's several hedge funds that have gone bankrupt. I think one was Stephen Cohen's something, whatever. I think that thing went belly up too. This happens all the time, right? So you have to understand, on the high end, what is the potential return? And on the low end, if you seriously underperform, then you're done. You're gone. You're done. That's it. It's lights out. Okay, time to take a nap, and you're not coming back. So all the bars, all the value at risk numbers are calculated here. We're looking at VARs over 95, right? 0.95% over. I'm interested in seeing that. What is the chance of seriously exceeding outcomes in the market? And I'm looking at VARs under 95%.